Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning, this is Peter Lewis, welcoming you to my podcast Money Talk for the final time this week. The weekend is almost here, it's Friday the 2nd of August. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 50 million customers across 10 countries. In today's business and finance headlines, the Bank of England on Thursday delivered its first interest rate cut in more than 4 years, lowering its key rate by 25 basis points to 5%. The bank rate has been held at a 16-year high of 5.25% since August 2023. The BOE warned people not to expect a sharp fall in borrowing costs in the coming months. Governor Andrew Bailey said policymakers need to make sure inflation stays low and be careful not to cut interest rates too quickly or by too much. Private sector survey data released Thursday showed an unexpected contraction in China's factory activity for July. The Caixin China General Manufacturing PMI survey revealed that manufacturing activity tumbled to 49.8 in July from 51.8 in the previous month and missing market forecasts of 51.5. It marked the first decline in factory activity since October 2023. US initial unemployment claims jumped last week while a measure of labour costs was unexpectedly low, according to economic data released Thursday. New applications for US unemployment aid, which is a proxy for job cuts, jumped to the highest level since last August, in a sign that the labour market is cooling. Meanwhile, unit labour costs, a measure of wages and productivity in the US non-farm business sector, increased at an annual pace of just 0.9% in the second quarter of 2024, well below forecasts of a 1.8% increase. Japanese stocks suffered a sharp sell-off Thursday after the Bank of Japan lifted its key interest rate for only the second time since 2007 and outlined a plan to taper its bond buying program. The Nikkei 225 tumbled 2.5%, while the broad-based Topics plunged 3.2%. The Japanese yen continued to strengthen against the dollar, reaching 148.5 during Tokyo trading. That hit companies such as car makers and other manufacturers with earnings that are boosted by yen weakness. Shares in Toyota, Panasonic and Japan's largest banks were among the biggest victims of the sell-off in Tokyo stocks on Thursday. Property stocks, which have thrived during the country's long era of ultra-loose monetary policy, were also hit hard. On today's programme, I'm joined by Francis Lund, the CEO of Securities, and Kenny Wen, Head of Investment Strategy at KGI Asia. And with a view from Australia is Toby Lawson, the CEO at Statton Partners. And if you want to get in touch with any questions or comments, as usual, please go to my website, peterlewismoneytalk.substack.com. US equities traded sharply lower on Thursday as a sell-off in big tech companies and chip makers weighed on the major US indices. The Dow dropped 495 points, or 1.2%, to end at 40,348, and at its session lows, the 30-stock index lost 744 points, that's about 1.8%. The S&P 500 shed 1.4% to end at 5,447. The tech-heavy Nasdaq Composite closed down 2.3% at 17,194, having slid more than 3% earlier in the day. Every Magnificent 7 stock except Meta ended lower. Nvidia tumbled 6.7%, taking the decline since its recent high on June the 18th to 19.5%. All but one company on the Philadelphia Semiconductor Index, which tracks 30 stocks in the sector, declined as it had its worst day since 2020 with a 7.1% loss. The sell-off came after weak economic data prompted recession fears and concerns that the Fed may be too late in starting to cut interest rates. Initial jobless claims rose the most since August 2023 and labour costs were much less than expected, and the ISM Manufacturing Index, which is a barometer of factory activity in the US, came in at 46.8. That's worse than expected and a signal of economic contraction. The yield on the 10-year Treasury note fell to below the 4% mark on Thursday, its lowest in 6 months. The yield fell 5 basis points to 3.98%. Yields on 2-year Treasuries, which are sensitive to interest rate expectations, fell 11 basis points to 4.15%. That's their lowest since February and down from just below 5% in late May. In the currency markets, the yen was one of the best performers Thursday. US dollar Japanese yen fell to a low of 148.5 during Tokyo trading on Thursday before rebounding to 149.32 yen per dollar, down 0.4% on the day. The offshore yuan fell 0.33% to around 7.25 renminbi per dollar after the private Caixin survey recorded the first decline in factory activity since October 2023. And gold futures touched a new all-time intraday high, sparked by rising Middle East tensions and increasing prospects of a Fed rate cut. But the precious metal ended the day 0.2% lower at $2,442 an ounce. Brent crude oil settled 1.6% lower at $79.52 a barrel. Bitcoin was hit by the overall risk-off sentiment, testing down to $62,000 before bouncing to end the day 1% lower at $64,100. And Chinese stocks were lower after China's factory activity contracted in July, according to the Caixin survey. The Shanghai Composite fell 0.2% to 2,932, and the CSI 300 was down 0.7%. In Hong Kong, the Hang Seng lost 40 points, or 0.2%, to end the day at 17,305, and the Hang Seng Tech Index closed 1.2% lower. Futures markets are pointing to quite a substantial loss for the Hang Seng at the open today. Looks like it's going to decline about 365 points, with the index starting the day around about 16,940. And you can get more details on the latest market movements in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
I do enjoy Friday mornings, and as always on a Friday morning, we find Francis Lund, the CEO of Securities. Morning to you, Francis.
Good morning.
And also with us is Kenny Wen, who is Head of Investment Strategy at KGI Asia. Morning to you, Kenny.
Good morning.
Well, look, 3 central banks have met in the last 24 hours. One raised rates, one cut rates, and then the third left rates on hold. So let's start first of all with the one that did nothing. That's the Fed. They left their key interest rates at a 23-year high. That was expected, but signalled it could lower borrowing costs in September. In a statement, the Fed said that its fight to stabilise prices had made some further progress, while noting that job gains had moderated and unemployment was rising. But the FOMC said that for now, it remained appropriate to keep the target for the Fed's funds rate in the range of 5.25% to 5.5%. That's where it's been since last July, and officials would need even greater confidence before they were willing to cut. Fed Chairman Jerome Powell told a press conference after the announcement a reduction in our policy rate could be on the table as soon as the next meeting in September, and he said there had been a real discussion at the FOMC this week about cutting rates. And the FOMC said it was attentive to the risks to both sides of its dual mandate, and no longer needed to be 100% focused on inflation, underscoring its shift to safeguarding the labour markets. Francis, let me ask you first. Is the Fed waiting too long to cut rates, and is it risking sending the US economy into recession?
Yeah, definitely. You see the market's reaction overnight. Dow Jones down almost 500 points, and Nasdaq down 405 points, and then very clearly the market is sending Jerome Powell a signal that we are on the cusp of a recession. I think that's what the people fear, and that the economic data have not been strong, and people worry about recession. It happened in China, in Europe, and also in the US. So I think that Wednesday night, Jerome Powell should have cut interest rate by 0.25%, boost the economy and the stock market, and reacting too late to help the economy.
Kenny, what do you think? Is he risking the soft landing that economists have been talking about earlier on in the year and hoping for?
Okay, maybe I want to talk about a little bit background because we think this week Federal Reserve meeting is very important because if you review past 5 or 10 years FOMC press release, you will find that if they want to cut rates or change their monetary policy, they will give you some hints before the rate cut meeting. So if you truly believe that they will cut rates in September, then they will change their wording in this time. But finally, we didn't change much for the press release. But Federal Reserve do have in the press conference saying that rate cuts should be on the table at the September meeting. So that's why the market is expecting a September meeting, a September rate cut. That because they do have a hints for us. Back to your question, I think it's very challenging for the Federal Reserve because don't forget that the Q2 GDP growth is talking about 2.8%, which is much higher than the market forecast. And then talking for the inflation is still higher than the 2% target. So how they can cut rates in this scenario? Just we have several, for example, leading indicator, for example, PMI, or saying that we have some slowdown in economy. So maybe it's a little bit too late to cut rates finally to prove that. But they just can't, it's not easy to do it given the current situation. So I think two key points. One, this Friday we will have non-farm payroll. That will be very important. Secondly, the stock market will be highly volatile. First of all, now the market is expecting 3 rate cut this year. I think it's a little bit too aggressive. But on the other hand, so finally, we may have less cut than the market expected. But on the other hand, if coming economic data is worse than market forecast, then their focus is not rate cut anymore. They will thinking about slowing economy. They will thinking about recession. That's obviously not good for the stock market. So in either direction, same will have volatility on the equity market. That is my observation.
And the Fed has given a clue as to what it's looking at, isn't it? Because Jerome Powell said they need to look at both sides of their mandate. In other words, they need to look at the labour market as well, not just the inflation data. But unfortunately for them, if you do look at the labour market, all the latest data, including what came out overnight, suggests the labour market is slowing quite fast.
Yes, you make a good point. Compared with other central banks, maybe just focusing on inflation, FOMC do have a deal target regarding labor market and also inflation. So it's a little bit difficult or challenging for them. And yes, we see there's a slowing down in the unemployment rate. So it's a really challenging to correctly predict the global macro and then make a rate cut decision properly. So I think their job is challenging, and that's why they always making mistakes. But anyway, when they make mistakes, maybe behind the curve or ahead the curve, then it's always not good for investors because that will bring downward pressure on the equity market.
I mean, Francis, if you look at the bond market is basically saying the Fed has left it too late. I mean, if you look at the way yields have plunged over the last few days, they are worried, aren't they, in the bond markets about a potential hard landing now?
Yeah, definitely. I think you can look at the jobs data, the July non-farm payroll. I think came in slightly below expectation. People were expecting an increase in non-farm payroll, around 200,000, same as in June. But it came in at about 185,000. It's worse than expected. And the same worries happened in Europe. And you see overnight, DAX, the largest stock market and economy in Europe, crashed 425 points. So that shows the the depth of the worry of policymakers. We are really heading into a recession. And of course, Chinese economic data were not good at all. And then and wow, then it's like all hell broke loose yesterday. So I think I think I will give a D or F grade to Jerome Powell.
Okay.
I think he should correct it right now.
It's going to be difficult, isn't it, though, unless they now act between meetings, which will then suggest that the Fed's panicking.
Yeah, that's right. What the government officials want to do is that they will never admit to mistakes. I think that is the problem.
So, Kenny, what about the Bank of Japan? This is important for Asia, really, isn't it? Because they raised rates by 15 basis points. So the range is now 0.15% to 0.25%. They're going to halve their bond buying. So they are tightening monetary policy, which, of course, is having a big impact in the yen. And in fact, just right now, the Nikkei 225 in Japan has just opened 4% lower. So this unwind of the carry trade is what's important for Asia, isn't it?
Before I answering the question on Japan, can I add some point on U.S. equity market? Just one point.
Of course.
I think not only the recession fear, maybe we can pay attention to those chip makers or AI stock. I think a key changes is what the investor focus. Before, of course, everyone know that they already have a 5 times, 10 times rally on their stock price. They are not cheap. That everyone know that. But there's some key changes on these few weeks. I think the investor focus from before is focusing AI development and can generate revenue. But after several mega cap, they reveal that or saying that they need to spend, for example, 8 to 10 billion every quarter on AI investment. That's what we call capital expenditure. So now investors will think that, yes, maybe can generate some revenue, but you need to spend too much. It will hurt your balance sheet. It will hurt your corporate earnings. So that's why these few weeks we can see that there is very obviously a sector rotation. So everyone, of course, going by bonds, but also the AI stock is suffer hardly because they worry about a recession will hurt the earning growth. They all also concerned about the capital expenditure. That is the key point I want to highlight. Okay.
Just on that point, Kenny, I mean, it's interesting, isn't it, what happened to Intel overnight? Because Intel, which is obviously one of the chip makers that is really trying to catch up with NVIDIA and others in the AI space,
forget Intel, because in the AI development, obviously AMD, NVIDIA is doing much better. So Intel is trying to catch up. So let's see. But anyway, their corporate earnings is within our expectation. So even though with a very low stock prices, they continue to correct. I'm not surprising because at least in this moment, he is the loser in the AI chip maker competition. So I think Intel is not worth to mention. Maybe when we have time, we can focus on Meta. Their corporate earnings is much better than our forecast. Especially they do have a healthy guidance for Q3. But anyway, back to you.
Okay. Now, back to Japan then. Obviously, the big news I think from Japan is the yen, isn't it? The appreciation of the yen. It's up about 6% since in the month of July. How important is that going to be for the rest of Asia?
Very important because, as we all know, we have the carry trade, that is borrowing Japan yen and then buying, for example, treasury to earn the interest differential. But if the interest rate go up, that will hurt your financing costs, and also it will bring upward appreciation on the yen that will decrease your capital gain from with a US dollar perspective. So that when the yen appreciate, you will cancel or the carry trade. Then you will need to sell those your existing holding. Maybe it's what we call U.S. equities. That will bring a downward pressure on global market. But I think on one hand is the yen appreciation. On the other hand is also the correction on the AI stock, because even though Japanese yen appreciated, but if you truly believe that your AI holding can have a double, triple, and I don't think I'll put it another way. The carry trade still can make profit, but now the situation is your existing holding is dropping down, and your borrowing currency is going up. It definitely hurt your position. So they may rewind or unwind the carry trade. That is not a good news for the equity or the asset markets.
Francis, it isn't just a coincidence, is it, that just as the yen started to appreciate about at the beginning of July, that's almost exactly the same point at which US tech stocks started to decline. There's a strong inverse correlation, isn't there, between these?
Yeah, it's a strange correlation, but correction in tech stocks, especially on AI chips, is really overdue. I think when you have NVIDIA, a mega cap increasing something like by 1.6 times this year, that many people are willing to sell off and lock in the profit. And that's what people did in the past 2 weeks. But we really have to wait until July 28th. If NVIDIA posts a blockbuster earning, wow, then the short sellers will be burned. So we'll wait and see.
How important is the carry trade to China? Because obviously the weak yen has put pressure also on the renminbi as well, hasn't it? And caused problems, well, not just for the People's Bank of China, but several central banks in the region. Now that the yen is reversing, what does that mean for Chinese markets and the currency?
Well, I think this thing happened last time in 1997 or 98. When the yen fell to 146 to the US dollar. And Zhu Yongji, the premier, threatened to devalue the renminbi because the devaluation of the yen put pressure on Chinese exports. And you can see that in the official PMI, which is below 50 for the past 3 months, I think. And then it's been keep on falling. It shows that it been by relocation and also maybe by the weakness of the yen. So I think China wants to get a better hold on its export position and its competitiveness in global markets. And so I think the yen appreciation is a good sign for the Chinese economy, at least on the export side.
Okay, well, we should finish off by just talking about the Bank of England for completeness. They were the third one in the trio. They cut rates, Kenny, didn't they? But then sort of almost indicated that it was one and done, that they're not going to do any more.
Yeah, so I think the impact is relatively limited because put it this way, even though maybe cutting rate or increasing rate, but I will say it is not like aggressive mode. So they just cutting one or two is not continuously reducing their borrowing costs. So the impact compared with Bank of Japan or FOMC should be, unless you have a lot of investment in England. Otherwise, I think the impact should be relatively limited, especially on Hong Kong, China market.
I mean, Francis, what's interesting is if you came from a different planet and looked at what was going on interest rates around the world here, you've got the Fed doing nothing, you've got the Bank of Japan raising rates, you've got the Bank of England cutting rates, and the People's Bank of China very aggressively cutting rates. It's a bit of an odd situation, isn't it?
Yeah, definitely. But in terms of economic cycle, I think everyone is entering into a down cycle. I think for Japan, the problem is that it has kept its interest rate far too low, kept its negative interest rate far too long. The time is overdue to raise rates. But for the rest of the world, I think because of the inflation caused by the Russian invasion of Ukraine, and it took several years, 2 years, for inflation to come down. I think it is time for global central banks to cut rates, especially the U.S., because they raise rates by 10 times and are too high, and it's hurting the global economy. And you see Europe, China, and the U.S. and Canada all falling into recession at the same time. So you know that something is not right. So I think the pressure is now on the Federal Reserve, U.S., on Jerome Powell. Please do something.
Okay.
Yeah, I agree that actually, even though for them this week they have totally different decision, but for FOMC just a matter of time to cut rates. So you can see that excluding Japan, almost a key central bank is cutting rates. So it proves that we may have a slowing down on global GDP.
And what about China? The data recently out of China, not good, is it? On the manufacturing side, the Caixin survey showed manufacturing in private companies, smaller private companies, falling into contraction. The PMI was down at 49.8. The official manufacturing PMI as well from the National Bureau of Statistics, also in contraction as well, and also worse than expected. I mean, Kenny, if the manufacturing side of China starts contracting, what on earth is left to try and sort of boost the Chinese economy?
Yeah, before talking the latest PMI, don't forget the Q2 GDP is only 4.7, which is much lower than the market forecast, say 5.1, even though we already know the April and May data. So you can see that Q2 China GDP is very disappointed. And for the latest PMI, as we all know, PMI is a leading indicator. So it showed that starting from February, we have a continuously slowing down in China economic activity. And the key point is, as I just mentioned, PMI is a leading indicator. So you can expect that in the mid of August, we will have retail sales, industrial production. That seems that we will not have any good news. So don't forget, it's talking about July. So more than half a year. So for achieving 5% GDP target, it's now become a little bit challenging for China. But we do not think they will have a totally policy shift immediately. So let's see what policy will be announced in coming weeks or months.
Francis, what's your take on the data and what it's telling us about the Chinese economy?
Well, it's certainly not good. It's there for the last 6 months. So China left a stone and threw it on its feet because of the overly zealous lockdown during the pandemic. I think the relocation of manufacturing by the multinationals really caused the slowdown in the export sector and also the manufacturing sector. So it will take some time for the country to recover. And I think China should have done much more in policy incentive to boost the economy. They really haven't done enough to stop the economy from declining. And you can see from the stock market, the Shanghai Composite Index is still 2932. And it hasn't risen for something like 10 years. So we are not doing anything at all. So it's a pretty sad state for financial people in China and Hong Kong.
I think one key focus we need to pay attention is the property sector. If the property sector cannot stabilize, it will hurt a lot of sectors and also bring them a negative wealth impact. So but it takes not only times, it takes many years to solve the poverty with a lot of unsold homes. So let's see what they announce in coming months, as I mentioned.
Well, we've been waiting a long time, haven't we, for the authorities to announce something. There's been a lot of talk, but not a lot of action. What would you like the Politburo to do? They met this week. They didn't really come up with anything, or certainly not any details of anything particularly meaningful this time around. So what would you like them to do?
I think they have set up a direction, and then other departments will make an execution or detailed planning or detailed policy. So coming weeks will be important. I still think that they have further room, especially now U.S. will cut rates. So the PBOC will have further room to cut the interest rate, and then also the RRR reserve requirement ratio, and increasing with they already issue a lot of very long-term bonds. They do have the capacity to enhance the fiscal policy. So a lot of things can do, especially for domestic the government. They can maybe on giving some motivation on consumption, just like Hong Kong. So I think a lot of things they can do, but are they willing to do to shift their policy mechanism totally different? So I think not a matter of whether they can do it, whether they want to do this is, but I don't know.
Francis, what would you like to see the Politburo do?
Well, at least try to save the property market, but it's difficult. It's very difficult because the amount is really far too big. It's more than $10 trillion. The property sector is something like more than 10 trillion yuan in the whole. And if you want the government to pour in that much money, well, it will be unfair to the other sectors in the economy. But without a vibrant property market, you just cannot stimulate consumption and other factors in the economy. So, but there was a piece of good news overnight in that, at least in Beijing, property prices have recovered, and they recorded the first month-to-month price increase for a long time. So maybe doing nothing is the best policy. Let the property market heal itself.
It takes many years.
It's going to take a long time, isn't it?
Yeah.
So in the meantime, let me get your thoughts before we go on the markets. July wasn't a great month once again for Chinese markets. The Hang Seng down over 2%. The China Enterprises Index down 3.5%. The CSI 300 down 0.6% over the same period. We've got more restrictions going on now, both in terms of things like short selling and also curbing information on fund flows into the market. What is this all going to do going forward for Chinese equities?
Well, we hope we can see a recovery, but what we need is really the national team buying up the market. Don't forget the Shanghai Composite Index is still below the 3,000 mark, which is considered the iron bottom. The iron bottom is it's just a paper bottom. So we want to see more.
But if we've got to rely on the national team to buy the market, it's not a very good sign, really, is it? I mean, the most they can really do is maybe stop it going down, but it's not going to help the market go up.
Definitely not. I think you need the economy to grow again for the stock market to rise. But well, of course, if the economy is not doing well, then I don't know what else you can do.
Kenny, what's your outlook for Chinese markets?
Okay, first of all, I will say not to trust the national team because they can only support the market for a very short period of time. So if everything is not good and we just have the national team, you should sell your holdings but not buying in, given when they support the market. And I like Hong Kong market more than the A-shares. And one key issue, we need to focus on corporate earnings. If more company like Standard Chartered or HSBC, which announce a better than market forecast result, then at least we can have several stocks can focus on, even though the general market still ups and downs. So I think corporate earnings will be the key.
What do you make of this news about restricting information on the amount of funds flowing into Chinese stocks? That's only going to be released now once a month, or in some cases only once a quarter. That isn't really the right way to encourage foreign investors back into the market, is it?
I don't make a right or wrong value judgment, but obviously it hurt investor confidence. But anyway, maybe for short term, they have their belief. But anyway, I think this is not good for the development of a equity market.
Francis, what's your thoughts on that?
Well, I think anything that really decreases the market transparency is not good. I think we have many people poring over all the data released by the government. You're putting all these people out of work if you don't release them. I think it's as little as possible. So I think I would want the government to release more figures rather than releasing less.
Okay, well, thank you both very much. Have a great weekend. You heard there Francis Lun, who is the CEO of GEO Securities, and Kenny Wen, who is Head of Investment Strategy at KGI Asia. I'm joined now by Toby Lawson, who is the CEO of Statton Partners down in Sydney, Australia. Morning, Toby.
Good morning, Peter.
3 central banks met in the last 2 days. 3 totally different outcomes. One raised rates, one cut rates, one did nothing. What are we supposed to make of that? Is this telling us that the global economy is just out of sync, or are some of the central banks out of sync with what's going on in the economy?
No, I think it's like a seasonal shift. When you get big seasonal shifts, you get volatility across. So, whilst we saw all central banks heading one way when inflation was rising, there is that adjustment period where, different economies will emerge in a post-inflationary environment at different speeds. And that's what we're seeing. So the Fed, for instance, they're probably well set now to look at a September cut. They were probably tempted a little bit, but I think unanimously, I think with the exception of one member, said that they would be on hold, but certainly indicated that they would go. The Bank of Japan was probably the surprise of the 3, if to be honest. So, no, I don't think there's any trend in that, and it's just that I think as you go through a seasonal shift from high inflation to low inflation, that you'll get some volatility in central bank decision making.
Well, let's talk about some of them in a bit more detail. First of all, the Fed, the one that stayed on hold and did nothing. There was a sort of increasing feeling that maybe the Fed has left it too late to start cutting rates and is putting at risk the soft landing that has looked on the cards for most of the year. What do you think? Do you think they are waiting too long?
Well, if you looked at the jobless claim figures from last night, they were the highest since August 23, and then you saw as well the ISM manufacturing figures were, well down, 46.8 on the index. Yeah, the argument there for the way the equity market and the bond market reacted last night, you would think so. And also, I think the Fed made a particular point about balancing the dual mandate between lower inflation and full employment. So there is some suggestion in amongst the commentary that they're a little bit more concerned about the labour force or labour market coming off a bit sharper, and hence they don't want to wait too long to move. So if they were particularly concerned, I would have thought they might have moved this month in the meeting. So I suspect they're looking at it, and some of the data on the labour market suggests some softness, plus the manufacturing sector and some of the corporate results are probably indicating that the economy has slowed a bit more dramatically than maybe we had envisaged a month ago.
And it was interesting, wasn't it? In the statement, they said for the first time, really, they mentioned the other side of their dual mandates, which was the labour markets. They've really focused almost entirely on inflation for most of this year. So is this really preparing the ground now for the cut in September?
Yeah, I think there's no doubt. And, the data we're seeing probably gives them good comfort to do it. Speculation will obviously change depending on what comes out. Now, if you look at some of the earnings figures, overall they're not too bad, but, some headlines a bit negative in terms of Amazon, the various factors, although Apple wasn't too bad. So you're going to get a little bit of volatility in the commentary and a little volatility in the data, but it would appear pretty certain now that they're lining up for a September easing. And what they're going to run into there is a political battle. Is September easing going to be challenged from a political perspective leading into the November election?
Now, in the case of the Bank of Japan, have they done the opposite? Have they rushed to raise rates and been a bit too hasty before the economy can really bear it?
Yeah, well, it was interesting. It was certainly a surprise because they hit on two fronts. They not only raised rates from their very, very low 0 to 0.1 range to 0.25, but they also made a decision to reduce the bond buying by 400 billion yen per quarter, which is, from about a total of 6 trillion. So quite a significant drop. So there was two fronts, and that surprised for sure. Now, the yen, as a bellwether of how investors reacted, strengthened somewhat, but didn't overdo it. Market probably had priced a little bit of that. So it was a surprise. And clearly they see that moving from 0.1 to 0.25 is not going to have too greater impact on the economy. So felt comfortable in order to do that. And obviously they see signs that the economy can withstand slightly higher rates.
And of course, the big impact has been on the yen, which has moved from 160 odd, 162, wasn't it, almost at one stage 3 or 4 weeks ago to below 150. Now got to 148, I think, in Tokyo yesterday. This is significant, isn't it, what's happening with the yen, particularly for other Asian economies and markets?
Yeah, so the initial reaction on the BOJ was sort of from 152 to 150, and then it's further consolidated, and that's probably partly due to moves in other currencies as well. So the yen's definitely stronger, and that has an impact regionally, and probably a good news story for Japan in that sense, because imports were becoming quite expensive and were potentially having an impact on economic activity. But overall, I think the BOJ felt comfortable that the move is not going to restrict activity dramatically because it's coming off such a low base.
And does this have an impact for Japanese equities? This morning, the Nikkei 225 has opened 4% lower. Is this sort of, all those stocks that did benefit from the weak yen, the exporters, the auto manufacturers and so on, are going to suffer in this new environment?
Probably a reaction to movements in the US markets last night. Nikkei's up 14% for the year, which is sort of equivalent to where the S&P is. So it's I think we're in for a correction potentially in equity markets in general. That maybe there's a good chance that we'll see further pullback in stocks over the month or so leading into the post summer period going into September. So nothing too dramatic in that, but yeah, there will be some adjustments based on an outlook for the export sector vis-a-vis what's happening in the globe around economic activity. So that softness in the manufacturing data in the US is a bellwether for overall softness in economic activity globally. That would impact equity markets around the world.
And for completeness, we should mention the Bank of England delivered their first rate cut in 4 years, but it's what we call a hawkish cut, wasn't it? They almost had to be dragged kicking and screaming to it. Very close decision, 5-4 split on that. And Andrew Bailey almost saying, don't bet on any more.
Yeah, it was a tight one, wasn't it? 5-4 on the voting, and so almost went to penalties, as they say in soccer parlance or football parlance. A knife-edge decision. Inflation steady at 2% gave them some confidence. The expression that inflation had eased enough doesn't really give you a lot of confidence that they've got a lot more banked in there. And some of the decisions of the government, the new government, in relation to public sector wages is something to keep an eye on. The Bank of England governor said it shouldn't have too much impact, but quite significant increases in some of the public sector wages does have obviously an expansionary impact on prices. So we'll be watching that over the coming months. So not expecting, a series of cuts at this point in time.
The inflation data doesn't really support it, does it? I mean, as the bank's chief economist said, domestic inflationary pressures are sort of becoming more entrenched, particularly on the services side.
Well, that's been the big issue, isn't it? The services sector. Now, that'll only come off when demand comes off dramatically, and maybe we see labour markets soften. And the reason demand will drop suddenly when labour markets get soft. People start to get nervous about their employment. I think the chief economist was one of the dissenting parties in the voting.
He was, yes.
If I'm correct, yeah.
He was.
So
yeah.
They're more concerned about that entrenched nature of services inflation. So, yeah, I suspect a 5-4 tells you that they're not convinced, but felt comfortable enough to take 25 basis points off. After 14 rate rises, one off's not going to have a huge impact.
Now, what about Australia? The Reserve Bank of Australia meets this week, just as inflation is rising. Inflation rose from 3.6% to 3.8% in the year to June after falling for 5 consecutive quarters. How significant is that?
Well, the feeling here was that the Reserve Bank just don't want to have to raise rates. And the result was just enough probably to give them a chance to say we're holding, because the underlying inflation, the core inflation, was a drop of sort of from the expectation of 4% to 3.9%, even though the headline went up, 3.8%. So I say it's a case for holding, but not a conviction that there's any rate cuts on the horizon. I think most economists are thinking early next year at the minimum for a rate cut in Australia. If you look in behind the numbers, the main concern continues to be some of those non-discretionary price pressures in the services sector, like insurance, shelter. But there was a nice pickup in food. Food went down sort of 0.5 basis point to 3.3%. So there was some good news in amongst it, but I think the analysis around here was that it was just enough for the Reserve to hold.
And what about the markets? We've seen a big sell-off once again. Very volatile trading, isn't there, at the moment in the US? We get big rebounds and then big sell-offs. Maybe the most significant move was in the bond markets overnight, with the 10-year Treasury yield dropping below 4% to a 6-month low. Now, that's signalling something there, isn't it? Is maybe the bond market's getting more and more concerned about a potential hard landing?
Yeah, I think they reacted quite sharply to the economic data. Spooked them a bit, I think, in the bond market. That certainly significant in my view. And volatility was up 13% on the VIX. So you've got to also allow for the fact that August is a volatile month, can be a volatile month because of liquidity. But putting that aside, it was definitely significant that the bond market reacted as sharply as it has. And bond 10 years below 4%, we wouldn't have picked that a few months ago, that's for sure. So, yeah, maybe a few people unwinding on bets that they had that haven't worked out. But, I was watching that, and I continue to watch to see how the bond market goes over the next couple of weeks, because it's always a good read, I think, on sentiment, the bond market.
And on the stock side, a lot of focus, I think, on AI spending, isn't there? Particularly in the results that we've been seeing this week from some of those big tech stocks, the Magnificent Seven. People really questioning, how much money is being spent and when are we going to see the payoff from that? Is that going to be an ongoing trend, do you think?
Yeah, I think so. I think that the analysis will get deeper, and as people lose a little bit of confidence, they start to question some of the exuberance around AI and the actual reality of monetizing AI. As you said quite rightly, there's a huge amount of spend in developing AI solutions, but does it come back in terms of profits and in terms of shareholder value? We'll wait and see. So it's an argument that tends to get illuminated when people are not so confident in starting to look for things to reasons to sell rather than reasons to buy. You've got to remember that the Nasdaq's still up 14% for the year. It's still been a pretty good run. So any correction, any moves at the moment are still pretty corrective to the trend. So it's always wary of making too many big calls at this stage. But I think you'll see sort of a much more attention on the reality of AI and what it will deliver in terms of shareholder value as we get a little bit more ahead of ourselves.
Toby, always a pleasure speaking with you on a Friday. Thank you very much indeed. That's Toby Lawson, who is the CEO of Statton Partners down in Sydney, Australia.
You're listening to Peter Lewis's Money Talk. Money Talk.
Thank you for listening to Money Talk this morning. You can find more details about some of those topics I've been talking about today in my daily newsletter. Take a look at peterlewismoneytalk.substack.com. There won't be a show on Monday. Money Talk will return on Tuesday, and I'll be joined by Mark Michelson, Chairman of the Asia CEO Forum at IMA Asia, and Nitin Dialdus, Chief Investment Officer at Mandarin Capital. In the meantime, have a great weekend, and I'll see you again on Tuesday.
Money Talk.